Sam Bankman Fried is a 30-year-old billionaire who co-founded FTX, one of the most used crypto exchanges in the world. The most recent market downturn in crypto and stock has given a lot of people a lot of opportunities to buy things on the cheap. And Mr. Billionaire here has been really busy buying things up. BlockFi was his most recent target. Last year, BlockFi raised a round of funding, valuing the company at around $4 to $5 billion. Due to the recent collapse of UST, Luna, and Celsius, and many more, which led to a collapse of a major crypto fund like the Three Arrows Capital, who BlockFi lent its funds to. So now BlockFi is left with no money. They still have to pay their customers interest on the coins they staked and allow withdrawals whenever possible. With crypto market fumbling, they were in a liquidity crisis. Fortunately, last week, Mr. Billionaire Sam and BlockFi signed an agreement, providing BlockFi $400 million in revolving credit, used to pay for client funds, and an option to acquire BlockFi at a variable price of up to $240 million. So we know what up to $240 million means. It ain't gonna be $240 million. And this company was just valued at $4 to $5 billion just 1 year ago. Incredible heist, Mr. Sam. No wonder your middle name is Bankman. While it's cool that Mr. Billionaire here can do whatever he wants in the private market, having access and opportunity to buy private companies like BlockFi, small investors like you and me just have to sit on the sideline and watch that happen. That's how the rich get richer. But does that mean we cannot participate somehow from this crypto crisis? I think I found an opportunity that you and I can participate in. Robinhood. It was disclosed recently that Sam bought around 7% of the Robinhood stake for $650 million in May. But I'm willing to bet my shoe that he will try to take over Robinhood within 3 months. But then again, I have many pair of shoes and I've lost a couple of shoes before. So don't really count on me on that. Where's my other shoe? I can't find it. But since we're speculating, let's do a little bit more research and see how likely that Sam will acquire Robinhood. So I first went on to the FTX website and I took a look at the number of people they're trying to hire. There are a couple openings in their product developer role. Now, is it easier to acquire a company or build a stock exchange from scratch yourself? If I were Sam, I would seriously consider buying Robinhood. This next part, we're going to talk a little bit about the fundamental analysis. And if you're not interested in that, feel free to skip ahead to the next part. So for a company like Robinhood, it's difficult to put a cash flow analysis for them because they don't really generate profit. They made about $300 million in revenue in March of 2022. However, they lost about $392 million in net profit. So they have a net loss for that quarter. So they make $300 million, but they lose $392 million. So that basically makes them a losing company. So the metric people tend to use to measure a company like this is monthly active user. And during its peak, it had about 22 million monthly active user on its platform, which is great. But currently, in the most recent quarter, it only had around 16 million monthly active users. So that's a significant decrease from its peak in terms of user activity on the platform. So I do want to point out that Robinhood does have around $6.3 billion sitting on its balance sheet. And its current market value is at around $7.85 billion. So it's only giving a little bit over $1.5 billion excess of its cash balance in its market valuation. And to some people, that might signal that Robinhood is really cheap right now. Since it's so hard to use fundamental analysis to gauge the true value of Robinhood, what I like to do is to use Kelly Criterion. So now we're going to use Kelly Criterion. Basically, what it does is it uses math and probability to give you the most optimal bet size in order to make the best speculation decision. There are a lot of limitations, but for the sake of this video, I'm just going to go over the cases that I modeled. And we're assuming, first of all, there's a 100% chance an acquisition will be attempted by Mr. Sam Friedman. And this one, we assume that we have a $10,000 portfolio that we can use to invest and not go bankrupt. And let's assume a acquisition price of $12, and we will give it a 60% chance that Sam's going to offer a $12 per share price for Robinhood. And that put Robinhood's market cap at around $10.446 billion. Remember, Robinhood has around $6.3, $6.4 billion of cash. So it's basically giving it a $4 billion markup compared to its assets. So now we're going to look at the strike price of the call options that expires for August 19th. So I'm assuming Sam's going to announce an acquisition by the end of August 19th. So there is a lot of risk here. I'm making a wild assumption that he's going to go with the same timeline that Elon Musk did. So for Elon, he began building up his Twitter stake in January 31st. And within 3 months time or 2.5 months time, it is made aware that Musk is making an intention to acquire a social media company. So January 31st to April 3rd, that's within 2.5 months. So Sam started building up his stake in early May. So if we do 2.5 months or 3 months time, it's gonna end around end of August or mid-August. So that's why I selected August 19th, because it has the most liquidity in terms of options volume. So assuming acquisition price of $12, we're going to buy strike price of $10 call, and $10 call costs 75 cents per share. So $75 per contract. And here is the Kelly Criterion optimized bet size. It suggests that assuming a 60% chance of a $12 offer, we should bet $3,600 and we'll make a profit of $6,000. But $3,600 is a large number compared to the $10,000 portfolio, which is why I tend to use a 1/3 Kelly Criterion allocation, which basically divides that number by 3. So now it's only $1,200 of a $10,000 portfolio, and that will yield a profit of $2,000. So of the two options of a $12 acquisition price, I did one for $10 call contract and $11 call contract. And the $10 call contract makes the most sense in terms of the profit it's bringing in. Then I do another case with a 30% chance of happening where Sam makes a bid of $16, which is a little bit just under 100% of its current market cap. Remember, its current market cap is around $8 billion. So assuming a $16 per share price, if we can buy a $12 call contract, $12 call, $13 call, all the way up to $15. We don't want to buy 16 because 16 gives us the right to acquire the shares at 16. If Sam wants to buy all the shares at 16, it does not make sense for you won't have any benefits of owning a $16 call contract. It won't go anything above 16. And of the 4 call contracts, $13 makes the most sense. We're making a $2,400 speculation that will yield $32,000 in potential return. This is a much better return than the $12 base case, but obviously the risk is that it's less likely to happen because $16 is a lot higher than the expected $12 acquisition per share price. And still, we're going to use a 1/3 Kelly Criterion allocation. $824 of a $10,000 portfolio will yield a $10,000 profit, which is really, really good risk and reward. Assuming, obviously, I want to stress this enough, it's a 100% chance of an acquisition attempt, and you were able to sell the contract when the news is announced, and you don't hold this to expiration, and the acquisition news is announced before August 19th. And finally, let's put a 10% chance of a $20 acquisition price. This is more than double the current market cap of Robinhood, which sits around $8 billion. So over a 100% chance, over a 100% increase in its current market cap. I put this case here because I think if Sam wants to make a serious attempt at acquiring Robinhood, he really needs to convince the Robinhood founders who owns just over 60% of all Robinhood stocks. At this price, this will make it tempting enough for the founders to sell their company. So off all the $20 acquisition price, I list out the potential calls that we can buy from $10 to $18. And out of it, $15 gives the most return. Of a Kelly Criterion optimized bet size of $775, we get a $37,730 profit, which is a ridiculous risk and reward. However, what really makes these sort of bets interesting to me, because I'm risking relatively small amounts of a portfolio to gain a lot of potential return. Obviously, the risk is that I'm assuming a 10% chance of that happening. This is assuming a acquisition is 100% as well. This probability will be a lot lower in real case, but for the sake of this video, I'm assuming 100% acquisition announcement. And if that announcement does happen, it's a 10% chance of a $20 acquisition bid. And applying the 1/3 Kelly criterion, we only spend $258 for a $12,000 return, which is a beautiful, relatively small risk to the portfolio, around 2.5% of the $10,000, 258 divided by 10,000, and gives you more than 100% return on your portfolio because it's a $12,000 gain. Thank you so much for watching. Remember, this video is for entertainment and education purpose only. I am not qualified to give any sort of sound financial advice. So just take my videos as entertainment and do whatever you want with your money. Don't blame it on me if you lose them all. All right? I'm not responsible. Please subscribe. I need more subs. I only have 110. Come on.